Good morning and welcome to this Monday, May 3rd, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've begun May. I'm sure most of you have heard the old Wall Street adage, go away in May. I'm not a big fan of that. There is some historical significance to the period of year from November 1st to April 30th versus May 1st to October 31st. I mean, the numbers definitely don't lie. And the November 1st, April 30th period is much better than May 1st to October 31st. So if if you have a choice which 6 months you want to invest, I would say absolutely it's the November through April period. However, we're not faced with that choice. So really the question is, do you want to sell at the beginning of May? And I'm going to say no, that you do not want to sell at the beginning of May. May and June, even into July, historically, this is not a bad period of the year. It's really more about the summertime. And as I've said many times before, if I was going to go away, it would be probably July 17th to about September 27th. That's when historically the market has really struggled to go anywhere. It has a historical annualized performance of below zero. So you actually do lose money during that period historically over the last 7 decades. So that would be your go away period. Again, July 17th to September 27th. The May, June period, I think you're missing out if you decide you don't want to stick it out. But anyway, we're going to get into some of that in just a bit. I do want to just invite all of you who are new to Earnings Beats to subscribe to our free Earnings Beats Digest newsletter. We publish it 3 times a week, Mondays, Wednesdays, Fridays. Sometimes we have little surprises in there. This morning is certainly one of those. If you are a subscriber, you can download our earnings reaction spreadsheet, which is many, many hours of work putting that together, really illustrating what's been transpiring so far throughout earnings season. I think it's pretty important, especially if you're a short-term trader. It's good information, actually, even if you're a long-term trader, because we've had so many beats, so many earnings beats, but the reactions have not necessarily gone in the same direction as the earnings per share. And so that creates maybe a little angst among some. For me, it's just a matter of, hey, we made a huge run up, and I think now we're consolidating in some of the areas of the market while other areas of the market continue to power forward. Anyhow, if you are interested in our Earnings Beats Digest newsletter, simply type in your name, email address, hit that subscribe button. No credit card required, completely free. You can unsubscribe at any time. We'd love to have you. Taking a look back at last week, on Friday in particular, it was not a good close on Friday, and it gave me reason maybe to be a little bit more bearish. I'm going to have to see some short-term strength to clear some hurdles before I'm going to be outright bullish. Now, I am bullish long-term. I mean, the secular bull market continues to move on. I'm not worried from a big picture standpoint. What I'm worried about is just short-term, not quite to the extent I was back in September, although we could get there pretty quickly here over the next week or two if conditions continue to build the way they are right now. But I'll talk about that in just a bit. On Friday, the Dow Jones finished down 185 points. S&P 500 was down 30. The NASDAQ down 120. Mid caps down 37. Small caps down 18. So you can see it was really across the board. Not very good action on Friday. The good news is that when you look at all of our indices relative to their 20-day, relative to their 50-day, everything's aligned nicely. The AD lines are strong. There's really not anything to be overly concerned about from an intermediate to long-term standpoint. It's more about the short term. And again, I'll talk about that in just a bit. One of the things, though, that is always a little concerning is when we start to see on a relative basis defensive groups doing better. Now, on Friday, we had a down day, so I wouldn't read too much into utilities, real estate, and staples being among the top 4 groups, along with discretionary. Discretionary stocks did well on Friday as well. So I'm not overly concerned about that. But, we are starting to see a little bit more relative strength in areas like real estate And when the S&P 500 is moving higher and you start to see a little bit more rotation into defensive areas, you at least have to be paying attention to that, because it's just telling us maybe that we've run a little too far. Market's getting a little bit more defensive. We'll talk also a bit about the volatility index, which has been on the rise of late, even though the market's been powering forward. That can be a warning sign. So some of these things are worth considering, at least in the short term. Energy did not have a good day on Friday. You can see down 2.5%. That was the weakest sector by far. But I believe we broke out of that bullish wedge middle part of last week, pulled back, maybe hit the moving averages. I would expect energy to move higher from here, but we'll see what happens. A move back below the moving averages, and especially back below the recent low, would negate that breakout of that bullish wedge. And it wouldn't necessarily mean anything horrible long term. In fact, I believe energy is going to go higher. I think everything is going to go higher in time. But if we do go back down below that low, then what it probably means is we're in more of a channel instead of a bullish wedge. And channels are fine. We made a big breakout just below the 45 level. And so that would be an area that I would watch if we did break below this earlier low in April. But overall, I still think the majority of what we see in the market, I think we're going to see higher prices. 10-year Treasury yield. Now this morning, economic news, haven't had anything out yet, but later this morning, we're going to get the April PMI manufacturing. March was 59.1. We're expected that to increase to 60.6 later this morning for April. So pretty good increase expected there in PMI manufacturing. The ISM manufacturing also out later this morning, expected to increase a little more modestly from 64.7 to 65. And then later this morning, March construction spending. As I've said before, I'm not sure how much we pay attention to construction spending because it's so far in the rearview mirror. I mean, we're talking about March, and now we're into May. But anyway, the construction spending number is expected to come in at 2%, a rise of 2%. February was down 0.8%, just to give you a little perspective there. Later this week, we've got the April ADP employment report coming out. That's on Wednesday. March number, if you recall, was 517,000. We're expecting that to jump to 763,000. And the April non-farm payrolls, 938,000 is the expectation for Friday. March was 916,000. And the estimates were pretty wide, anywhere from about 750,000 to about 1.25 million. So the estimate that I'm giving you is just that. It's an estimate. It's an average, 938,000. But those that are forecasting are all over the place. So it'll be interesting to see how that comes out on Friday. Unemployment is also expected to drop from 6% to 5.8%. So a couple things to look forward to on the economic calendar later this week. In the meantime, let me get this update here on the 10-year Treasury yield. We're down about 1 basis point, 1.63%. We did bounce off the 50. We now can see that PPO starting to turn back higher on the 10-year Treasury yield after coming down and resetting at the center line. Also got that 50-day test. All of this came after we had the negative divergence, higher yields with lower PPO. That normally means that rising 20 period moving average is no longer going to hold, and that's exactly what we saw in April. We saw a little pullback in some of the financials as a result, but now that we're starting to pick back up again, we're seeing financials also picking up again. So I still believe we're going to go higher in the yield. I think we could be looking at 2%, 2.25%, maybe even 2.5% later this year. I don't expect the Fed to do anything. They would have to reverse course off of what they've said they're going to do. I think unless they begin to change their opinion on inflation, I don't think that they're going to be coming off of their stance of no rate increases this year. That's just my opinion. And I don't think at this point they're too concerned about the economy overheating. In fact, they kind of, I think, would like to see the economy overheat a bit and even generate a little bit of inflation, because they've said it's okay if it goes above our target 2% level. We're not going to jump, at the first sight of inflation running hotter than expected, because they believe that any increase in inflation is transitory, or meaning very short term in nature, and that we will revert back to that 2% target. So I don't know what might change over the next few months that could alter their view. I don't think too much is going to change. I think that the market is the economy is kind of doing exactly what the Fed expected. And so I don't see any major changes. So I think I think the Fed's going to remain very accommodative, which I think will be good for the market. But that's not going to change the impact, I think, on the 10-year Treasury yield, which in my opinion will start to move higher again and perhaps move above that 2.25 level later this year. All right, let's move on. So what I wanted to talk about now, talking technically today, was I wanted to get in and look at some of these sectors relative to the S&P. So I'm going to start off with a couple of the aggressive groups. This is the technology group relative to the S&P. So here's technology relative to the S&P 500. So this is not necessarily saying that technology is going lower. It's just saying technology is underperforming the S&P 500. Now, the S&P 500, you can see, has been going up from this high in February, where technology was leading, to this high now at the beginning of May, where technology is lagging. We've seen S&P continue to move higher, and that's a little bit of a concern. Although if you've been following the market, you know technology had a huge run. So it's okay. It's just like a stock. Just because a stock's going sideways for a while doesn't mean it's a bad stock. Many times it's just a stock that's in consolidation after a huge run. So I would look at technology the same way. What I don't really want to see is a situation where we start downtrending, like we put in the lower relative low, lower relative high, and then we come back down and break down, all while the S&P keeps going higher. That would be a little bit of a warning sign. Now, that would just be one sector, but still, that would be a little bit of a warning sign. We move on to the XLY. This is consumer discretionary versus the S&P 500. And similar story, early February, leading on a relative basis, S&P at a new high. And since then, you can see the XLY on a relative basis has been moving lower. Although it is trying to turn up, we're starting to put in higher lows, higher highs. So I think consumer discretionary looks a little bit better right now to me than technology. Financials, here's what I was talking about. Relative basis financials moving down, but with that 10-year Treasury yield now stabilizing and starting to move up, you can see financials starting to lead again. I suspect, and I'm not a huge fan of financials over long periods of time. I think financials, you want them to be healthy. You want them to go along for the ride. You don't necessarily want them to be the leaders. It's okay if they lead for a while, and I think we're going to see some of that. But eventually, I want to see technology and consumer discretionary regain their lead. To me, that's much more bullish. Gives me a much better feeling about the move to the upside. Industrials also tend to move like financials. I do like to see industrials lead a bit more than I would say the financial group. But here we can see we had pulled back again. That coincided with the yield falling back, and then as the yields picked back up again, we're starting to see strength again in industrials. But here's the one that's a little bit more worrisome, and this is real estate versus the S&P 500. Now, keep in mind that a secular bull market, one of the hallmarks is wide participation. It's okay for real estate, utilities, healthcare, consumer staples. It's okay for those groups to lead for periods of time. And in fact, when the market pulls back, like it did in late January, the S&P drops, real estate takes the lead. That's okay. And that's typical. When the market sells off, we tend to see money rotate toward defensive groups. But when the S&P starts doing this, and the real estate starts doing this, where we're going up and leading to the upside, I get a little bit more nervous. And I'm not talking about a long-term top. I'm not talking about, okay, the secular bull market's over. I'm talking about short term. So this is just, to me, a little bit of a warning sign, because what it's telling us is that Wall Street's getting a little bit more defensive. And so I don't know, it's kind of like building a house out of paper. That first storm comes along, the house is gone. And so, when you start seeing defensive groups leading to the upside, it just makes me feel a little bit more uncomfortable in the short term, that if some bad news were to hit the market, the footing of the market is not quite as stable. And so that's something that I'm kind of watching. Now, it's not been horrible with all the defensive groups. So I kind of want to see what happens here over the next couple of weeks. But I wrote an article over the weekend. I think I published it Saturday morning. And if you didn't already see this, this was, is this a sell on news top? And I gave 5 warning signs, and one of them wasn't real estate. These are 5 other warning signs that I provided. One, overbought conditions. This is almost a yawner for me, because in a secular bull market, many times we're overbought. And if you sell every time the market gets a little bit overbought, you're going to really probably be very disappointed, because the market can stay overbought for a period of time. So if you get out when it first gets overbought, sometimes you miss out on big runs. So overbought conditions are a warning sign, but that by itself would not take me out of the market. NASDAQ fails at resistance. So at Wednesday evening last week, we got earnings news out of both Apple and who was the other one? Apple and Microsoft? No, what was it? Microsoft? Facebook. Got it written out there. I just have to read my own article. Apple and Facebook report after the bell last Wednesday. Both blew their numbers out of the water. I mean, revenues, earnings, everything. Looked at Apple's report. Apple beat on just about every metric. Revenues, earnings, profit margins, everything. Just a great report. Facebook, very similar, very strong. We gap up to an all-time high on the NASDAQ. And surely this is a group that's been, underperforming for the last couple months. It was leading the market until February. And then while the S&P and the Dow and everything else broke out the new highs, the NASDAQ consolidated. So with that news, the NASDAQ had a chance to regain some of that leadership that it had lost. And instead of seeing buyers take over and send the NASDAQ to new highs, big hollow candle, we got the opposite. Now, we did see some buying off of the low, which was good, but the failure was still undeniable. Also, higher prices and a lower PPO. Now, the PPO wasn't that high to begin with. I'd be more concerned if, we were up here 2 or 3 on the PPO, and then we had the negative divergence and we hit, resistance. But negative divergence is a negative divergence. It does still show some price momentum slowing. And then with the failure at the top, it's just another piece. Again, by itself, would this cause me to sell all my stocks? No. But as part of a few other problems, it starts to add up. So this was an intraday chart last week. So this was Apple and Facebook reporting. This is a 10-minute chart, 5 days. So this would have been last Monday, Tuesday, Wednesday, Thursday, Friday. So Thursday morning, we broke out. We had this huge breakout ready to roll. And look at all the selling that took place in the first 2.5 hours. We went from 14,210 down to roughly 13,950 and change. I mean, that's a lot of points that we dropped, 240, 250 points on the NASDAQ in, that's, 2.5 hours. We got a little rally, but then see how we just kept working our way back down, set new lows by the end of the day on Friday. Just not a good feeling, not a good reaction to what we saw throughout the day. Or throughout those 2 days. So I'm just a little nervous now with the NASDAQ failing. Then let's talk about volatility. Now, rising volatility by itself, anytime the market goes down, volatility goes up. So it's always this inverse correlation. Well, I shouldn't say always, but generally it's this inverse correlation that's typical. So the S&P 500, when it's rolling to the upside, the VIX is usually falling. And when the S&P is starting to fall, the VIX starts to rise, showing increased fear. That's normal. What's not normal, and when you look at it on a correlation where we look at the S&P and the VIX, if you look at this, we stay down near -1 most of the time, which means we have perfect inverse correlation most of the time, which is what I was just saying. Whatever one does, the other does the opposite. Well, when you get into a situation where you start seeing this correlation move back to the zero line or even above the zero line, you ought to at least be thinking, okay, maybe I need to be a little bit more cautious here, because essentially what's happening, if the S&P 500 is going up and this correlation is going up, then it means the volatility is rising while the S&P is rising. that tells us the market's getting more nervous as prices rise. Now, this doesn't work every single time. If you look back the last time in December of 2020, we went positive, and you look up here, we really didn't do much of any selling at all, and then right back off to new highs. So like any other technical indicator, I don't know of any that are guaranteed. Hindsight is about the only thing I know that's guaranteed. I can tell you what happened last week and last month and last year. But when you're looking forward and you're trying to make predictions, I don't know anything in technical analysis that's a guarantee. But you can go back and see when things happen and get a sense of, maybe what could happen or what some of these things are signaling. And so if you look back to some of these highs, now 2017 was a year when we saw the market get nervous, but we just kept going higher. I don't think we ever had an S&P 500 pullback of 3% throughout the entire year. I think it was the record. I think it was an all-time record back in 2017. The market just kept going up, up, up. So even when the market got nervous, nothing really happened. But there have been some times where this has marked major tops. Now, if you look back at the beginning of 2017, the last significant pullback came with this correlation at 0.5. Now, we had another one later in the year, 0.5, and really didn't do anything. The next time we had one, this was the highest reading of the last 5 years, or maybe it was in August of 2020. But 0.75, we're really starting to turn into a almost hand in hand. The S&P is going up, and so is the VIX, kind of a thing, over a period of time, not one day. This is over 20 periods, and it's a daily chart. So this is over a 20-day period. When you start to see movement over zero, that's pretty significant. And you can see it doesn't really happen that often. So when it does happen, just be aware. Here at the end of January 2018, it marked a top, very significant top. Here we got to about the zero line and it marked a top. Here we got to the zero line, just above the zero line, it marked a top. Here it didn't. I mean, it was probably right around in here when we went above zero, and that one didn't really work that well. Here in August or September, this was one of the reasons I wrote my September 3rd article last year and said, we've got some major warning signs. And when I see this go to 0.75, that to me tells me I better at least either have puts in play, maybe move more to cash, maybe sell calls against the positions I own, anything to help mitigate some of that risk. Then in December, we had a move up here. It didn't really work. And so here we come back up again. Now, we're not there yet, but I would watch this, because if we continue to move up over the next couple of days or maybe even the next week or two, and we get this going above zero, the volatility goes up with the S&P 500, I think you at least need to be considering doing something that makes you feel more comfortable at night, whether it's selling partial positions, selling calls, buying puts on the S&P, anything just to protect, a little insurance in the event that we move lower. I never use technical analysis for guarantees. Some people, look at something that doesn't work in technical analysis, and then they just, slough off technical analysis just saying, oh, this doesn't work. It's not designed to be a guarantee. It's not designed to work every time. What we're looking for and what we're using technical analysis for is to identify the risk that we're taking and then decide, do I want to take this risk? Do I want to leave all my money at work in the market? It's giving us that opportunity to say, okay, our risks are higher. What do we want to do? And so watch this, because I think this is going to be pretty important. Another thing, historical performance. April 1st to May 15th, historically, the S&P 500's annualized return during this period, and it's May 15th, 12 days away, by the way, now. But this period that we're in right now is strong. When we get to the second half of May and throughout June, the percentage change dips very significant. The annualized return goes down to plus 1.70%. This is data going back 70 years. And not only, you might say, well, that's just odd. The next 70 years, it'll probably go the other way. I don't think so. I think the reason that it happens is April 1st to May 15th is when all the earnings, we get the pre-earnings run up at the end of March and into early April. throughout maybe the first 2 or 3 weeks, and then the earnings start coming out. And generally, earnings beat estimates. And so the market reacts positively. We go up, and then the earnings are done. And the market has nothing to trade off of until the next quarter's earnings come out. And so this is kind of typical, not just of this quarter, but every quarter except for the fourth quarter. And I think that's because of the holidays and everybody's in a good mood and whatnot. But I would be careful as we get closer and closer to the middle of May. Last thing is earnings reactions. And this is the spreadsheet. Now, this is just a recap. I mean, the spreadsheet itself contains hundreds of companies. So you can go in, and we've identified each one of these companies that have reported their opening gap, their intraday move, and their daily change. This is just a summary by sector. So where consumer discretionary shows 46 companies that have gapped higher after earnings, and 36 have gapped lower. Those 76 companies are on a separate tab in the spreadsheet, and I'll show you in a second. So you can go in and look to see which ones were the best, which ones were the worst in those areas. So I think all of this is really interesting information to have, because you can see different sectors are treated much differently. And the one that really stood out to me was technology, the intraday move. So technology stocks on average gapped higher. 54 technology stocks so far have gapped higher, 39 have gapped lower, and we have a net average slightly above zero. So if you're holding technology into the open, generally, on average, you've done okay. But once the opening bell hits, this has been by far the worst group, minus 1.89%. Materials are the second worst at minus 1.21. And look at the odds of a technology stock continuing to move higher throughout the day versus lower. 25 of the 93 moved higher after the opening bell to the closing bell. 68 moved lower, and the average was down 2% almost. The flip side of that is energy, 17 to 13, going up 1% during the day. And so they gap up. So energy gaps up 20 out of 30 times so far, continues moving higher 17 out of 30, and ends the day higher 18 out of 30. So energy, I would say, is among the best in terms of how they perform throughout the day. And that's the only sector out of 11 that is averaging moving higher during the day after reporting earnings. 10 out of 11 have gone down. The worst, technology. The second worst, materials. The third worst, consumer discretionary. So discretionary gets a nice pop at the open, and then throughout earnings season so far, essentially just giving it away during the day. So if you're holding a stock into earnings and you get that, you're fortunate enough to get that opening gap higher, and you can see of these companies, 404 total went higher at the opening bell, 284 went lower. But during the day, 287 go higher and 401 go down. So that tells me might not be a bad idea maybe to take at least partial profits at the opening bell if you've got a stock that's gapping up. That's what history is telling us so far. Now, I'm going to show you one other thing here. Let me, I'm going to pull up this spreadsheet just to give you a sense of what's on here. So this is the spreadsheet that shows all the data. So here's 414 earnings reports, 415 earnings reports, 416, 417, or no, not 417, 419, 420. So these are the earnings reports that have come out. These were the ticker symbols for the stocks. And this was the sector report that I just showed you that I'd copied and put into my article. And then here's the sort by sector. So if we wanted to, we could go in and look at energy. Let's see if we can find energy. Here's energy. So here are the companies that have reported in the energy space so far. Here was the closing price, and then you've got the opening price the next day, and then the close that day. So these two columns right here show you what happened during the day. Open to the close. And then that's over here in this column, 3% move up. So you can take a look real quick and see what the individual companies have done. Many of these energy companies have moved higher after the opening bell. But we've got all the different sectors broken down there. Then you can sort by opening gap, or I can sort by opening gap, and you can see which companies have had the best reaction. And that's sorted in initial reaction order. So the opening gap. Then I've got the sort by daily change. So from one close to the next, it's looking at these two prices. So XM, a software company, had a one-day change of 22%. And then the intraday move. What did well during the day? And that's over here in this far right column. And you can see a bank company. Here's oil and equipment. Look at all the oil, equipment, and services companies. 4 of them in the top 10, basically, because they've been bought up throughout the day after the news comes out. So keep that in mind. I mean, as we look at earnings going forward, I can't guarantee that's going to continue, but that has been the trend so far in earnings season, is that when the energy companies report, they get bought. When technology companies report, they get sold. Let's go down to the bottom. So here at the bottom, here you can see Cohu Semiconductor went down 16% intraday. It actually was only down 0.6% at the open. Fell 16% during the trading day. Then you've got PI, which is telecom equipment, Amcor Semiconductor, TWOU software. You can see these big moves made intraday. Now, the other thing that all these spreadsheets have are the upcoming earnings. So I did this. This was actually Friday's earnings, but this was done during the day on Friday, so we didn't know what the close was at the time. But even beyond Friday, if you go down here, you're going to have, here's Monday, Tuesday, 5/4, Wednesday, all these companies. So anyway, I think it's great information. If you like Excel, if you like to do analysis, you can take this and then analyze this data however way that you wish. But here is all the data already done for you through April 29th. And then you can update it as you see fit. So just wanted to point that out because this is a pretty cool feature that we've added. And right now we're giving it away to everybody, but this is something we're going to continue to do for our members. So as we update this, we'll certainly let our members know and give you the details of what's happening in the market. All right, couple earnings reports, and we're going to wrap this thing up. Estee Lauder reported. Let's get a quick update here. They did easy beat $1.62 versus $1.29, and the stock gap down 4%. But it had already gone up a lot. So that's the thing you face with holding stocks into earnings. It's not whether they report great numbers. I can usually predict fairly accurately which companies are going to report really good numbers. But trying to predict whether the market sells off or continues to send it higher after those earnings is really hard. It almost to me feels like a coin flip. Now, using some of the data that we've done based on the spreadsheet I just showed you, maybe we have a little bit more of a chance as we see how the market is creating and treating these various groups. Let's see, what else did we have in earnings? Let's try, DNLI was up 6% in pre-market. Yeah, that didn't last. They missed on their earnings. I was really surprised. But anyway, they're expected to lose 37 cents. They lost 58 cents. And then I'm going to pull one more up. This is an energy stock. So I wanted to see, because we just talked about energy. So WEC reported $1.61 versus $1.47. It opened at 96.48, which was down 71 cents. And it looks like it's just barely down from that level. But based on our analysis, what I would say is that the odds probably are greater that WEC goes up today, throughout the day. Again, that's just based on what the market has been doing with energy companies. Some of the technology, though, has not been treated so well. So maybe looking at another company. Actually, this will be the first 3 you must see. Let's take a look at On Semiconductor, because On Semiconductor has actually gapped down 38.22. It's rallied back about 54 cents. But remember, these technology companies after the opening bell have not done very well. Now, maybe because On has gone down 4 days into its earnings report, maybe it'll be a little different. We'll have to see. But I would be a little nervous knowing what the market has been doing. Maybe just keep a stop in below today's earlier low. A second one, let's see, AMG. This will be a second of the three you must see. AMG beat 428 versus 426, but it's in the asset managers group. And the asset managers group, you can see, has been very strong of late relative to the S&P 500. It's one of the strongest areas right now. And AMG has been a pretty strong stock within this space. A lot of good news already built in. So the good news came out. It looks like the stock is flat right now. I mean, if it took a move back to the 50-day, it'd probably be a great opportunity, because we haven't seen a 50-day test since back in October on AMG. But this is a stock that's been very strong. And then the last one I'm going to give you is a company that will be reporting this week, and it's at a major support level, and that's Peloton. So I'm going to see if it's broken down here. No, it's trying to still hold. I'm going to draw this trend line here on Peloton. You know, the chart itself does not look very bullish to me. I mean, you can see left shoulder, neckline, head, neckline, right shoulder, and we're back down here again. But we haven't broken down yet. We're in a bull market. So I'd caution you to be too bearish until you see a breakdown. But I think 97.32 is the lowest open or close so far. So if we were to get a close below 97 or 96, you start seeing selling, big selling, heavy volume, I would be more nervous with Peloton in that situation. Right now, maybe this is where it launches from. I don't know. This is one to watch. Anytime a stock hits a support level this many times, though, it's a big support level. So we don't want Peloton to lose it. And the thing that's really been interesting to me is that throughout all this selling, that the AD line is held up pretty well on Peloton, which tells me that while a lot of the retailers are selling, we still have institutions buying. Now, maybe that changes on a big volume sell-off. That would certainly take the AD line down. I don't know. But anyway, just an interesting stock. And they, like I said, they will be reporting this week. I think in our portfolios, we have 4 portfolios, 4 stocks in each, which is 40 total. 17 of them will be reporting earnings this week. So this is going to be a big week for our portfolios. And hopefully we get some positive reactions and not just positive results, because for the most part so far, I think the results in our portfolio stocks have been mostly positive, but the reactions have been very mixed at best. All right, let's take a quick look at the market, and then we're going to wrap this thing up. Right now, we got the Dow up 225, S&P up 17. NASDAQ on a relative basis, not participating today, though. Up a little bit, but not to the extent that we're seeing the Dow and S&P. We do have the S&P 600 and 400, so small caps and mid caps leading again after they gave up some at the end of last week. So that's a positive. But overall, still pretty good action in the market. But don't lose sight of those warning signs as we move on throughout the rest of this week. All right, everybody have a great day. Be back tomorrow over at Stock Charts TV for your next Trading Places live episode. It will air at 9 a.m. Eastern. And again, you can get that at Stock Charts TV. So stockcharts.com, and then click on the Stock Charts TV at the top, 9 a.m. Eastern, and you can catch my next episode. Everybody have a great day. Happy trading.